Hello, welcome to APPNA's Wealth Management Strategies for Physicians webinar focused on investment principles. My name is Feroz Ansari and I'm the Senior Principal and Portfolio Manager at Comapk Asset Management. Since this is an investment-related webinar, I will begin by quoting Warren Buffett, and he said, "It is not necessary to do extraordinary things to get extraordinary results." Recently, American Medical Association undertook a survey and found that only 5% of their physician members said that they are well-versed and knowledgeable in investments and financial planning. 71% of the members said that they do not have enough information or training in investments and financial planning. You work hard for what you make. It is imperative that your investments and your savings perform well so that you achieve the financial success and the financial freedom that you and your family so deserves. So when we talk about investments, it may seem simple, and here are the 4 investment principles that we will discuss in detail today. You look at the first one is your risk profile and investment horizon. Second is diversification. Third is asset allocation and consistency. And fourth is portfolio costs and taxes. Starting with the first principle, which is risk profile and investment horizon, it is imperative that you recognize what is your risk-taking capacity. If you are dependent on a portfolio and if the value goes down, what will happen to your lifestyle? What will happen to your retirement income? So your ability to accept risk, which is called risk capacity, is very critical, and you should know what is your capacity of bearing risk. Second is risk tolerance. 2 people in the exact same financial situation may choose a very different strategy based on what they are comfortable with. People make investment choices based on their life experiences. People make investment choices based on how they have invested in the past. So it's some people by nature are risk takers. Other people are conservative. Some people, if their portfolio is down 5, 10, 15, 20, 30%, it does not bother them at all. They don't even look at their statement and say, you know what, I'm fairly comfortable with the market. I will let my investments do their thing and not worry about it. There are others who feel that if their portfolio is down 15, 20, 25%, they have these thoughts that their financial future could be ruined. So they make decisions which may be suboptimal. So you need to look inside and see, where do you fall on this risk tolerance continuum? Who are you as an investor? So, and that analysis is very important, because if you know yourself, you will make better investment decisions and you will stay with that strategy. Then the third factor is required return. What do you need in order to achieve a certain outcome? If someone has $3 million in their retirement account and they only need $100,000 a year, then their withdrawal rate is 3.3%, as opposed to another individual who has $3 million but requires $200,000. They need a withdrawal rate of 6.7%. So here, the first person or the first physician could take a lot less risk and still meet their requirements or their income needs, as opposed to the second person who may require a more aggressive portfolio or a greater allocation to stocks. So you need to understand what you are trying to accomplish and how can you structure your portfolio so that you can achieve your goals based on, again, what your life goals are, and those life goals and those financial goals will determine your required rate of return. Now, the time period is also very important. How long are you investing for? If you're looking at a 35-year-old or a 40-year-old who still has about 30 years of saving and investing, their portfolio could look very different than somebody who is 68, 2 years away from retirement, and they will be dependent on that portfolio for their retirement income needs. So the longer the time period, the more you can invest in stocks. So here is an interesting chart which shows this analysis goes back from 1950 to 2016. And here the green one is the S&P. These are stocks. The blue is the bonds. And the gray is the 50-50 portfolio, 50% invested in stocks and 50% invested in bonds. So during the 66-year period, the worst performance that an individual or an investor could have if they invested in the S&P could be 39% negative. And the best performance is 47% in stocks. So here is the worst outcome in 66 years in the stock market, and here is the best outcome. In bonds, it is 8% negative, 43% positive, but in a 50-50 portfolio, the worst outcome in any given year during the 66-year period is negative 15% and a positive 33%. Now, on a 5-year period, on any rolling 5-year period, so we can go from 1950 to 1955, or you could go from 1951 to 1956. So any 5-year period, if you were invested in S&P 500, the worst return is 3% per annum over a 5-year period, so 3% compounded annually negative, or 28% is the best outcome compounded annually over a 5-year period. On stocks, it is -2 and +23. But here in an asset allocation, over any 5-year period during the 66-year time horizon, the worst that any 50-50 diversified portfolio investor would have witnessed is a 1% positive return per year, or a 21% on the high side. So the lowest return is 1% per year, and the highest return in a diversified portfolio is 21%. Now let's look at a 20-year period. Here, when you look at these bars, they are much tighter. What does it mean? S&P 500 over any 20-year period delivered a worst per annum return of 7% and the best return of 17% a year. Bonds had a 1% per year return over 20 years. That's the worst case. The best case is 12%. And then if you look at diversified portfolio, 50% stocks, 50% bonds, any period, any 20-year period during this horizon, investment horizon, had a return of the worst return of 5% and the best return of 14%. What does it say? If you have a longer time period, your volatility or the overall fluctuation in the portfolio would go down, and you can have a higher certainty. So if we are forecasting the returns for a 3-month period or a 1-year period, it is very hard. But when we are forecasting returns for 5, 10, 15, 20 years, there is a greater certainty. We have much more confidence in the historical rate of returns. So if you are investing for 20 years and you have a diversified 50-50 portfolio, it is very likely that your range of return would fall between 5% a year to 14%. Now, moving on to the second principle of investing, which is diversification. In simple words, diversification means that don't have all your eggs in one basket. As the economy moves through different cycles, government policies change, monetary policy evolves, fiscal challenges are different in each economic environment. Wars break out. There are crises in different parts of the world. Risk appetite and risk perception for investors evolve. So as these different things are changing and as economic fundamentals are evolving, different sectors in the market and different asset classes are hurt and helped by these developments. But it is not easy to say which sector or which asset class will be hurt and by how much, or which will be helped and to what degree. In my opinion, stock market is a level 2 chaotic system, meaning that even the predictions about the stock market, they impact the outcome or the performance of the stock market. So can somebody predict the market? Is there a pattern? Over a long period of time, we have much greater certainty. We have a higher confidence. Now, when you are creating a diversified portfolio, what to invest in? Should it be stocks? Should it be bonds? Should it be cash? Should it be REITs? And in what proportion? So let's look at this chart. So here we are looking at returns on different asset classes from 2000 to 2016. So this 15-year period, if you look in 2002, commodities had the best performance in 2002. In 2003, they were pretty much at the bottom of the chart. In 2007, emerging markets did the best. In 2008, they were the worst. Then again in 2009, they were number one. And then again in 2011, they were at the bottom of this table. What is it telling you? That asset classes and their return, they go up and down. Let's look at bonds. In 2008, bonds were the best investment. In 2009, they were at the bottom. In 2010, they were again at the bottom. In 2011, they got to the top of this chart. So what we can deduce by looking at this chart is that it is very hard to predict which particular asset class will do the best in the next 12 months. So what is the solution? What is the answer? The answer is a diversified portfolio that is properly allocated. So now let's go back to this chart again and see, if you look right here, an asset allocation portfolio that is invested across stocks, bonds, REITs, and commodities, it is pretty much in the middle of this table. So if you look right here, even when things didn't go very well for investors in 2008, a diversified portfolio was only down 25% compared to emerging markets, which were down about 54%. Now, if you look over this 15-year period, a properly diversified portfolio delivered a 6.9% rate of return during this time period, which is 2002 to 2016. Now here, during this time period, we witnessed two very big bear markets, or historic bear markets. First was the tech bubble from 2000 to 2002. Second was the Great Recession in 2008 and 9. But even after going through those two major bear markets, then a properly diversified portfolio delivered a rate of return of 6.9% with a volatility of 11. So what it tells us is that if you have a diversified portfolio, if you have an efficient portfolio, you are more likely to have an attractive rate of return with volatility or with drawdown that is acceptable to you. Drawdown and volatility which is not excessive. So the goal is to create a diversified portfolio. But we all want to have a diversified portfolio, but it's not easy. Because as humans, we are all impacted by our biases, and we use heuristics to make decisions. Look at this chart. Here, the United States economy represents 22% of the world's GDP. The United States stock and bond market accounts for 36% of the total capitalization of stocks and bonds in the world. But look at a US investor. Their portfolio is domestic to the extent of 74%. So 74% of their stocks and bonds for a US investor are all domestic. Let's take this analysis one step forward. Here, people on the East Coast, what do they know? They see financials. So what do? They over-allocate or they overweight financials in their portfolio compared to national average. If you look at the West Coast, what do people do here? Well, they are in technology. They understand technology. So what do? They overweight their portfolio in technology. People in the Midwest, they know industrials, they overweight industrials. People in the South, they are big in energy, they overweight their portfolio to energy. So here, what we see is that people make investments based on hunches. They make investments in stocks or bonds based on what their neighbor might tell them, or they make these investments by what their friends are telling them, or what they see on the street, or what they see around themselves. So again, the goal is that we need to come out of this situation of personal bias and create a portfolio which is properly diversified, which is efficient, and which can do well during different market environments, and is not concentrated in one particular type of assets or stocks or investments. The third principle is asset allocation and consistency. You create a diversified portfolio that is very well allocated and then staying consistent with that strategy. Now, we all want to be consistent, we all want to be disciplined, but it's easier said and done because the stock market is primarily driven by fear and greed. And we know through behavioral finance studies that the pain that investors feel from a loss is 3 times greater than the pleasure that they have from a gain. So continuously the stock market is moving or is witnessing, or investors are experiencing this feeling of fear and this feeling of greed. Investors buy when the markets are high, they sell when the markets are low, then when the markets are down. So it's the exact opposite of what they should be doing. But again, our mind or our brain is wired that way, and it's very hard to stay disciplined and to avoid these traps. Look at this chart right here. During the last 20 years, S&P has returned 8.2% every year. This is the annualized return over a 20-year period. A 60-40 portfolio has delivered 7.2% a year. But an average investor in the United States earned only 2.1%. They could not even beat inflation, which was 2.2%. So why does it happen? Why did an average investor only make 2.1% while the S&P delivered 8.2%, or a diversified portfolio delivered 7.2%? Because investors are not aware or do not recognize and implement the 4 principles that we are discussing and learning about in our webinar today. Now look at the chart up here. It shows that in October 2007 was the peak of the market, and here there are 3 types of portfolios: 40-60, 40% in stocks, 60% in bonds. Then the other portfolio is 60% in stocks, 40% in bonds, and the third one is all S&P. So from the peak in 2007, we had this big decline, but if it was a 40-60 portfolio, the decline was only about 20%, and then very quickly this portfolio bounced back, and by November of 2009, you were pretty much at your highest point that you were at back in 2007. If it was a 60-40 portfolio, it took about a year longer, but by October of 2010, a 60-40 portfolio was back at the same peak as it was in October 2007. Now, if this was a all equity portfolio or the S&P portfolio, it did have a drawdown of about 50%, and it took a lot longer, but if you stayed invested, it would have come back, and all 3 portfolios did pretty much the same. So what do we learn from it? What we learn is that it is important that we create a portfolio or an asset allocation that we can stay consistent with, that we are emotionally okay with the expected drawdown in that strategy. So here is another chart which shows why it is difficult to stay consistent and why it is hard to endure the volatility. So let's look here. 28 out of 37 years, the stock market has been positive. But every year, the stock market experiences an average decline of 14.2%. So you see all these red dots? This is the decline every year. So in 1980, even though at one point the market was down 17%, it closed up 26%. If you look at 1998, the stock market was down 19, but it closed up 27. So there is, even though we talk about this 8% return in the stock market, there is no 8% here. It is either 26% or 4% or negative 2%. Now, if you do not have a proper asset allocation, during the tech bubble, the S&P declined about 46%. Would you have stayed with your strategy, with your investments if they were down 48%? Here in 2008, the stock market declined 49%. Would you have stayed with your investments if they went down 48%? What's the solution? The idea is not always to have a portfolio which is 100% stocks. The goal is to create an asset allocation between stocks and bonds and other asset classes that you are comfortable with, that you can maintain and that you can stay consistent with. Now, the last principle is portfolio cost in taxes. It comes in the end, but it's still very important. So here I asked my team to create an analysis using the actual S&P returns from 1996 to 2016. So if you started with a $100,000 investment in 1996, by 2016, if you had an expense ratio or expenses of only 1.5, your portfolio would have gone up to $319,000. But if you did not have 1.5% expense ratio or expenses or cost in your portfolio value would be $432,000. So you're leaving 35% of your profit on the table if you're paying 1.5% and if your manager is not adding value or is not outperforming the market. So the goal is to bridge this delta or to reduce this delta as much as you can by reducing the cost in your portfolio. You cannot control the return that you have in the market, but you can certainly control the cost that you incur for management of your portfolio, the taxes that you pay because of trading and capital gains, or the interest that you receive on the bonds that you invest in. So those are choices that you can make, and that can significantly improve the outcome and investment performance. Going to the next chart, the previous chart was for a tax-free portfolio. This chart is for a taxable account. It could be an individual account, it could be a trust account, or a joint account. And here the difference is even more profound. What you see here is a delta or 63% right here. So the 100,000 grew to 265. It could have grown to 432,000. You're leaving 167,000 on the table, and the assumption is only 1.5% expenses and 15% in capital gains and 20% turnover. I can tell you, I have seen portfolios that have much higher turnover, that have much higher cost, and their portfolios are not cost efficient or tax efficient. If you could create a strategy which is cost efficient and tax efficient, your outcomes can be so much better. Your performance could be enhanced by big numbers. We are talking in this example 63% over a 20-year period. So these were our 4 principles. Let me recap these principles one more time. The first is your risk profile and investment horizon. You should, when you're looking to invest, look inside, look at your circumstances, and then determine the time period that you're investing for. And that will determine how much you should allocate to risk assets, meaning how much you should be allocating to stocks versus bonds. Second, don't put all your eggs in one basket. Have a diversified portfolio and make it efficient. Third, when you create an asset allocation which is properly diversified, stay consistent. Don't let your emotions dictate your investment strategy. And then last but not least, manage your cost, reduce your taxes. And I can assure you, if you were to implement these 4 ideas in your portfolio, you will do exceptionally well. You will do better than I would say 90% of the investors out there. Even though these principles sound simple, but they are very important. Now, what you should do when we end this webinar is look at your portfolio and see whether your investment strategy is in line with these 4 investment principles that we have discussed today in quite a bit of detail. Again, I would like to thank you for listening to this APPNA webinar for financial, which is focused on financial strategies for physicians. My name is Feroz Ansari. I'm the Senior Principal and Portfolio Manager at Comapk Asset Management. Thank you for your time. If you have any questions or you would like to discuss your investments or your portfolio or your financial strategy, please reach out to me. You can send me an email or you can call my office. Again, thank you very much. I appreciate your attention.